Larry Culp, joining us now in a CNBC exclusive as Larry Culp, who's the chairman. Nice to have you. First, just give me, the stock is down rather sharply this morning, in part because of disappointment about the reported quarter, perhaps as well continued concern that you voiced about inflation and supply chain. So give me the big picture here. Talk to your investors. Are they correct in selling the stock this morning based on the numbers that you put out?
David, good to be with you, gentlemen. A pleasure. I think what we shared this morning with investors, David, is that we had a strong bottom line finish to 2021. Operating margins up over 200 basis points in the quarter, 400 for the year. We saw a strong cash flow finish in the fourth quarter, $3.7 billion overall. And as we look at it operationally for the year, we came in at $5.8 billion. And that's where a lot of investors were frankly focused during the course of our call, because that's the best mark that I know to measure our underlying operating performance and the strength and the potential across our portfolio. When you couple that with the updated debt reduction, now $87 billion over the last 3 years in the wake of the AerCap GCAS merger, which we closed in the fourth quarter, we're really positioned, I think, to move forward. You saw the announcement 77 days ago with respect to the spins.
Yes.
But that debt reduction also carried with it an opportunity to simplify our financials. So we go from 3-column reporting today to single column. I think that's going to make GE's performance and its potential far more accessible, David, to investors. But admittedly, there's a little bit of noise in taking people through that transition today. So we're hard at that. But I think the feedback we've gotten relative to the program that we've been on, and certainly the announcement with respect to setting up these independent industry leaders, continues to be strong. And as we look forward, we have a lot of conviction about what we're doing here.
Yeah, well, listen, you've got a lot of transitions to come, obviously, over the next 2 years with the split that we discussed a couple of months back when it was announced. Let's talk about this year, though, because you did cite inflation and supply chain. Inflation more in one part of your business, namely, it would appear onshore wind and the grid, and supply chain more acute in healthcare. Larry, explain both the impact of inflation on one side and the supply chain on the other.
David, when we talk about supply chain, we're really talking about availability of material and labor, be it in our own shops or from our suppliers around the world. We certainly saw, I think, what many, many companies have seen through the course of 2021 with respect to shortages and extended lead times. That was most acute for us in healthcare, particularly given the electronic and plastics nature of much of what we buy. We saw in the second half alone, the nature of much of what we buy. We saw in the second half alone probably 8 to 9.22 because we couldn't ship orders that we had in hand. We're working through that. We saw that in the fourth quarter to a lesser degree in other businesses. We hope that we see that clear in the second half in healthcare and are working hard to control and affect as much of that as we can. Price cost certainly was a pressure for us in 21 and will be in 22 as well. That was widespread. We feel steel most particularly in renewables for sure. But again, I wouldn't focus on any one commodity. I think we're seeing what so many are. It's incumbent upon us to take the cost actions that we have to mitigate that as much as we can and push price where we can as well smartly. And I think we've saw in the fourth quarter some progress in that regard.
But it does introduce a lot of at least questions for the year ahead, it would seem. I mean, again, you had guidance for this last quarter, which may have been missed a bit. Larry, how confident are you in the numbers that you're putting out there in terms of free cash flow and revenue and margins for 2022?
David, I don't put numbers out that I don't have extreme confidence in, right? If you look at what we did in 21, and again, I'm very proud of the work this team did, particularly with respect to generating nearly $6 billion of free cash. We certainly are going to have headwinds, and you touched on too, supply chain and inflationary pressures. We have some other dynamics that we need to work through, but frankly, that's always the case in business. When you look at the strength of these franchises in aviation, a business that's poised for an aviation recovery. We were talking about business travel before I came on. A healthcare business that is seeing strong demand in both the private and in the public sectors, constrained at the moment with new leadership, lots of momentum with respect to new products and commercial execution. That business is getting better every day. And if you look at what's happened in power, where we've seen very good margin expansion, gas turbine utilization is up. We know we've got work cut out for us in renewables, in part because of soft revenues here in the U.S. with the lapsing of the production tax credit. But I think that, too, will resolve itself. So there's a lot of good things going on today. Maybe a little bit of noise in today's results, but the guide that we offered up, $5.5 to $6.5 billion of free cash, gives us an opportunity to grow year on year our cash from core operations, despite probably about $1.5 billion of additional headwinds that we didn't talk about from the remainder of capital and the resumption of deliveries with our airframer customers. So all in all, we'll take that environment because I think it sets us up not only for a good 22, but all the more another step forward in 23.
Okay, so Larry, I'm inclined to like GE, as you know. You focus on the, let's say, $5.8 billion free cash flow. In the new world was defined by what happened in November when the Fed wanted to get tight. I only really care about earnings, frankly. And when I look at earnings and I look at renewable, I don't see earnings. And I'm trying to figure out if I were an acquisitive company, Thermo Fisher, I would call healthcare and say, hey, listen, you know what? Maybe we should do something. Maybe I should buy you. But when I look at renewable, I think, it's okay, Larry. I mean, maybe it's not really right now business.
Jim, it's a business, and it's an important business. If you look at what we do in onshore and offshore wind and with the grid, the energy transition won't take place without GE playing a critical role. We need to make it a better business. We get that, on this. If you're from Missouri, I get it. I'm from Nike. We're going to just do it because we know we've got the backdrop of demand over the medium to long term. We know how to work through the supply chain and these inflationary pressures. There are a whole host of things that are, frankly, within our control. We'll make progress next year. It won't be a positive print here in 22, unfortunately, but progress in 22 sets us up in 23. And that coupled with what we do in power, where we've run the same playbook, I think, with better results, given the stability and underlying demand. It may not be a business that has the profile of aviation or healthcare, but it can still be a good business. It's an important business, but it's on us to make it better.
All right. I think that's fair because right now when I talk to the utility companies, everyone's kind of full up. They just don't need the new power right now versus, say, healthcare. If you got all the parts you needed, how many MRIs could you sell versus what you're selling now?
Well, I don't know about the MRIs in particular, Jim, but again, if you look at the print, we have probably 800 basis points of core revenue in the back half of 21 that went missing simply because we didn't have adequate supply. And I don't mean to blame our suppliers. They're working very hard hand in hand with us. But that suggests a business that is significantly constrained in the face of not only strong market demand, but outstanding relative performance.
Larry, I bring this up somewhat hesitatingly, but, Steve Tusa has been right for a long time, or at least was years ago. He's very critical this morning, the analyst at J.P. Morgan. And I want your response. He says, putting aside the fact that this is the worst disclosure, least transparent set of numbers we've ever seen in 20 years following the group, forcing high-level analysis for now. This is an operating miss on revenue, profit, and orders basis. But respond to Mr. Tusa when he says the worst disclosure they've seen in over 20 years.
David, I think if you talk to investors in the community, if you talk to our board, our audit committee, our auditors, our internal team, I think all of us are proud of the improvements that we have made in our reporting and our transparency. And that pride and that commitment to moving forward stands today. So I think our record and our disclosures today, our upcoming 10K, stand on their own. And I think in the clear light today, I think people see the progress that we're making. They appreciate the transparency, understand the transition out of GE Capital creates a little bit of near-term noise. And that's the audience that we're most focused on, frankly.
Right. I guess there are those who still feel like they can't get a sense for the total earnings power or the earnings power of the total business right
that's
now.
That's what we're focused on.
Yeah. And
what is the earnings power?
There you go. So we'll both ask the question, Larry.
Well, I think the earnings power is a combination of what we've just talked about relative to the core growth that we see in the business. We talked today about high single-digit growth in 22. margin expansion. We've talked about 150 basis points at least of additional margin expansion in 22 with very good cash conversion, right? And that's a good thing. Let's be clear. More cash generated is a good thing. And that's how we get to the $5.5 to $6.5 billion range that we've talked about for this year, despite the $1.5 billion of headwinds. And we reiterated today our confidence that we can continue to drive those operational levers to yield $7 billion of cash in 23. Now, I think we'll see our cash conversion normalize over time. But again, because we've got an aviation recovery very much in the early innings, a healthcare, a high margin, high growth healthcare business that is supply constrained at the moment, I think the setup here is strong.
All right. Well, we will leave it there. And as you know, always appreciate your willingness to take time, take the tough questions. Larry Culp, CEO and Chairman of GE. Thank you.